There's a moment that repeats in financial history, a moment when the mathematics stop being theoretical and become violent, when leverage that created paper fortunes transforms into a liquidation engine that destroys real wealth. It happened in 1929, when 89% of the stock market's value vanished in less than 3 years. It happened in Japan in 1989, when their market collapsed and never recovered. It happened globally in 2008, when the financial system came within hours of complete shutdown. And every single time the people living through it believed they were different, that they'd evolved past the old rules that new technology and sophisticated policy had made crashes obsolete. They were wrong. Because what destroys markets isn't external, it's mathematical. A 7-stage sequence that plays out with mechanical precision once certain conditions align. And right now in 2025, we're in stage 5 of that sequence. The same stage that in 1929 gave way to catastrophe within 18 months. This isn't prophecy. This is pattern recognition. And once you see it, you can't unsee it. Let me take you back to 1920. World War I has ended. America emerges as a creditor nation for the first time in its history. European powers owe billions to American banks. The industrial capacity built for war needs peacetime markets. And the Federal Reserve, created just 7 years earlier, in 1913, is still learning how to wield its power over the money supply. In 1920 and 21, the economy suffers a sharp but brief recession. Factories that had been running full tilt for military production suddenly face collapsing demand. Unemployment spikes, commodity prices crater. But then something happens that will set the stage for everything that follows. The Federal Reserve decides to stimulate. They slash interest rates. By 1924, the Fed discount rate sits at just 3%. Commercial banks, taking their cue from the central bank, begin lending freely. Credit becomes cheap. Mortgages become available. Installment plans let ordinary Americans buy cars, refrigerators, radios. For the first time, consumption doesn't require savings. You could have it now and pay later. But here's what nobody understood at the time. When credit becomes too cheap for too long, human behavior changes. Why save for something when borrowing is nearly free? Why invest in productive enterprises that take years to generate returns when you can speculate in assets that double in months? The entire incentive structure of the economy shifts from production to speculation, from saving to borrowing, from patience to leverage. By 1925, the shift is well underway. Stock prices are climbing steadily. Not dramatically yet, but enough to catch attention. Enough that people who had never considered buying stocks before start asking their friends and neighbors about this wealth creation machine. And their friends tell them, "It's easy. You don't even need much capital." There's this thing called buying on margin. Margin lending is the original financial weapon of mass destruction. Here's how it worked. You walk into a brokerage with $1,000. The broker says, "That's wonderful, but why limit yourself? Put down that $1,000 as collateral, and I'll lend you $9,000 more. Now you can buy $10,000 worth of stock. If that stock rises 20%, you haven't made $200. You've made $2,000. Your $1,000 stake just became $3,000, a 200% return, and all you had to do was borrow. The beauty is obvious. The danger is invisible until prices fall. If your $10,000 position drops just 10%, you're down to $9,000, but you owe the broker $9,000 plus interest. Your entire $1,000 stake is gone, and if prices keep falling, you owe more than you have. The broker makes a margin call. You must deposit more money immediately, or they'll sell your stocks to cover the loan, and they'll sell at whatever price they can get. By 1927, margin lending has exploded. The total amount of money borrowed to buy stocks grows from $1 billion in 1921 to over $8 billion by 1929. That's an 800% increase. But that number alone doesn't capture the danger. $8 billion is roughly 8% of America's entire GDP. Imagine if today, when U.S. GDP is about $28 trillion, there were $2.2 trillion in margin loans just for stocks. That's the scale we're talking about. But it gets worse because it's not just investors borrowing from brokers. Brokers are borrowing from banks. Banks are borrowing from other banks. And some banks are borrowing from non-bank lenders who are borrowing from whoever has cash sitting idle. The entire financial system becomes a tower of debt, each level dependent on the one below it, continuing to pay, continuing to function, continuing to believe. Let me give you a specific example of how insane this gets. There's a phenomenon in the late 1920s called the call money market. This is where brokers go to borrow the money they lend to their margin customers. And in 1928 and early 1929, the interest rates in the call money market sometimes spiked to 12%, 15%, even 20% for overnight loans. Think about that. Brokers are paying 20% interest to borrow money for one day. Why? Because they can lend it to stock speculators at even higher rates. And those speculators will pay because their stocks are rising 30%, 40%, 50% per year. This is the logic of a bubble in its purest form. Borrow at any rate, because the returns exceed any cost until they don't. And corporations are getting in on it too. Companies that make actual products, that operate factories and employ workers, they look at their cash reserves and think, why is this sitting idle earning 3% when I could lend it overnight to brokers at 12%? So they do. By 1929, major industrial corporations are diverting cash from operations into the call money market. They're acting like banks. No worse than banks, because banks at least pretend to assess risk. These corporations are just chasing yield with money that should be funding inventory equipment wages. This is stage one of the pattern. Easy credit creates artificial prosperity, not real growth, not productive investment, but a financial carnival where everyone's borrowing to speculate and calling it wealth creation. And you can track this in the numbers. Between 1925 and 1929, the Dow Jones Industrial Average rises from 100 to 381. That's a 281% gain in 4 years. But corporate earnings, they grow, maybe 30%. Dividends increase modestly. The price appreciation is almost entirely multiple expansion. People paying more for the same dollar of earnings because they believe prices will keep rising. Now let's be clear about something important. In 1925, this doesn't feel like a bubble. It feels like progress. America is booming. Factories are humming. Cities are growing. New technologies, radio automobiles, electric appliances are changing daily life. There's real innovation happening, real productivity gains. Henry Ford's assembly line is revolutionizing manufacturing. General Electric is bringing electricity to millions. RCA is making radio a household staple. The economic growth is real, but the stock prices are growing faster than the economy. And that gap, that divergence between real growth and financial asset appreciation, that's where the danger lives. Because at some point, asset prices have to reconnect with economic reality. And when they do, when that gap closes, it doesn't close gently, it closes violently. By 1927, something else is happening that will prove critical. The Federal Reserve, watching the stock market climb and inflation remain tame, decides to cut rates again. They drop the discount rate from 4% to 3.5%. Why? Partly because European central banks asked them to. Britain and Germany are struggling. Their economies haven't recovered from the war. They need lower rates to stimulate growth. And because the world is still on the gold standard, if U.S. rates are too high, gold flows from Europe to America, draining their reserves. So in a gesture of international cooperation, the Fed eases, and this accelerates everything. The stock market, already rising, begins to melt up. 1928 is the year speculation becomes a national pastime. Everyone is talking about stocks. Newspapers publish daily market updates. Radio shows discuss investment strategies. Ordinary Americans who never owned securities before are opening brokerage accounts. Teachers, factory workers, shopkeepers, they're all buying stocks on margin, convinced they've discovered the secret to wealth. And maybe the most dangerous development of all, the investment trust boom. Investment trusts are the mutual funds of the 1920s. They pool money from investors and buy portfolios of stocks. Sounds reasonable, right? Diversification, professional management, all good things. Except these investment trusts have a feature that makes them ticking time bombs. They use leverage, massive leverage. Here's how it works. An investment trust raises $10 million from investors. Then it borrows another $5 million from banks. Now it has $15 million to invest. It buys stocks. Those stocks rise. The trust's net asset value increases. And because investors are chasing returns, the trust's shares trade at a premium to its assets. So the trust might hold stocks worth $15 million, but its own shares trade for a total market value of $25 million. Investors are paying a 67% premium for the privilege of owning a leveraged, professionally managed portfolio. But it gets more insane. Some investment trusts buy shares in other investment trusts. You get these nested structures where Trust A owns Trust B, which owns Trust C. Each one leveraged each one, trading at a premium to its underlying assets. It's financial engineering designed to multiply returns on the way up, but it will multiply losses on the way down with equal ferocity. By 1929, there are nearly 750 investment trusts managing over $8 billion. To put that in context, that's nearly as much as all the margin loans in the entire stock market. The most famous example is Goldman Sachs Trading Corporation. Goldman Sachs, even then a major investment bank, launches this trust in December 1928. It raises $100 million, a staggering sum. Immediately, the shares begin trading at a premium. Investors are so eager to get in that they will pay $140 for shares with an asset value of $100. Goldman Sachs, seeing this enthusiasm, launches another trust in July 1929. This one's called Shenandoah Corporation. It raises over $100 million more. Goldman Sachs Trading Corporation invests heavily in Shenandoah. Then in August, they launch a third trust, Blue Ridge Corporation. Shenandoah invests in Blue Ridge. You see what's happening. It's a matryoshka doll of leverage and premium valuations. When the market falls, this structure will collapse floor by floor like a condemned building. And nobody cares. Nobody's asking what happens if prices fall. They're too busy counting their paper gains. By mid-1929, speculation has reached fever pitch. Stock prices are rising so fast that people quit their jobs to trade full-time. Brokerage offices are packed with crowds watching ticker tape machines cheering as prices climb. It's like a casino, except everyone's winning. Everyone's a genius. A secretary buys 100 shares of RCA in March at $85. By September, they're worth $420. She's made more in 6 months of speculation than 2 years of salary. Why would she keep working? This is stage 2 of the pattern. Speculation replaces investment. Asset appreciation becomes its own justification. Leverage is seen as intelligence rather than risk. And everyone believes they're participating in a new era of permanent prosperity. Now let me show you something that nobody talks about, but is absolutely critical to understanding what comes next. The people who saw this coming, because every bubble has its skeptics. It's Paul Revere riding through the night, trying to warn people, and 1929 is no exception. But what's fascinating is who these skeptics are and what they do with their knowledge. Joseph Kennedy is one of the most successful speculators of the 1920s. He's made millions, maybe tens of millions, running stock pools. These are coordinated schemes where groups of wealthy traders bid up prices in a specific stock, creating the appearance of demand, then dump their shares on retail investors who pile in late. It's legal, it's common, it's how fortunes are made. But by the summer of 1929, Kennedy is getting out. The famous story, probably apocryphal but revealing nonetheless, is that Kennedy decides to liquidate after his shoe shine. Boy gives him stock tips. If shoe shine boys are speculating, Kennedy figures there's nobody left to buy. But the reality is more calculated than that anecdote suggests. Kennedy understands something most investors don't. He understands the mathematics of leverage and forced liquidation. When everyone owns stocks on 10% margin, a 10% decline wipes out their equity. When their equity is gone, brokers issue margin calls. When margin calls go unmet, brokers sell the stocks. When brokers sell, prices fall further. When prices fall more, investors hit their margin limits. It becomes a self-reinforcing cascade. And once it starts, nothing can stop it until all the leverage is purged from the system. So Kennedy doesn't just sell. He begins building short positions. He's betting against the market. When stocks fall, his shorts will profit. He's not trying to save the world. He's positioning to get richer from the disaster he sees coming. And he's not alone. Bernard Baruch, the legendary financier who had advised presidents and made fortunes in previous panics, has also been reducing his positions throughout 1929. Baruch is in his late 50s by this point. He's lived through the panic of 1907. He's seen bubbles form and burst. He knows the signs. Years later in his memoirs, Baruch writes that by the summer of 1929, he could sense danger in the very air of Wall Street. The conversations had a manic quality. The confidence had crossed into recklessness. The optimism had become a kind of religious fervor. It reminded him of every bubble he'd witnessed, and bubbles always end the same way. Suddenly, by October 1929, Baruch has converted most of his portfolio to cash and government bonds. He's out. But it's not just American investors who are spooked. European money has been fleeing since August. British banks watching American stock prices climb to levels that defy any fundamental analysis are quietly liquidating their U.S. holdings throughout September and early October. They've seen manias before. The South Sea Bubble in 1720, railway mania in the 1840s. They know that when valuations detach completely from earnings, when speculation becomes universal, when everyone believes this time is different, that's precisely when it's not different. That's when it's most vulnerable. French investors are pulling money out. German banks are reducing exposure. The smart money, the institutional money, the old money that has survived multiple boom-bust cycles, they're headed for the exits. And then there's the Federal Reserve itself. Throughout 1929, the Fed has been trying to cool speculation by raising interest rates. The discount rate climbs from 5% at the start of the year to 6% by August. They're also engaging in what they call direct pressure, essentially jawboning banks to stop lending for speculative purposes. But it's not working. The market keeps rising. Why? Because the call money market is offering such high rates that money is flooding in from non-bank sources. Corporations, wealthy individuals, even foreign investors are lending to brokers because the returns are irresistible. The Fed's normal tools, interest rate policy, and bank regulation, they're not reaching this shadow financial system. And that should terrify everyone because it means the central bank doesn't actually control the credit cycle. They think they do. They have these levers and buttons, but the speculation is being funded outside their reach. When this goes wrong, they're going to discover they have far less power than they believed. Here's another signal that almost nobody notices at the time, but becomes obvious in retrospect. Corporate insiders are selling. The executives and directors of publicly traded companies, the people who know their businesses better than anyone. They're unloading shares in massive quantities throughout 1929. These aren't routine diversification trades. These are systematic liquidations. In some cases, insiders are selling 50%, 60%, 70% of their holdings. Why? Because they know their company's earnings don't justify the stock prices. They know that the market has priced in years of growth that may never materialize. They know that when reality reasserts itself, their shares will be worth far less. So they're cashing out while retail investors are still buying the dream. And here's a detail that's particularly damning. Some of these insiders are simultaneously telling the public that business has never been better, that their companies have never been stronger, that investors should hold or buy more. They're lying. Not technically because business is good, but they're omitting the critical fact that good business doesn't justify insane valuations. It's fraud by omission, and it's legal. Trading volume is also sending signals to those who know how to read them. Throughout September 1929, daily volume on the New York Stock Exchange is hitting unprecedented levels. 3 million shares, 4 million shares. Days that would have been remarkable a year ago are now routine. On the surface, this looks like enthusiasm, more buyers piling in. But professional traders know what's really happening. High volume during a mature bull market usually means distribution. The smart money is selling to the dumb money. Large institutional holders are unloading positions in size, and retail investors are eagerly buying, thinking they're getting in on the action. This is stage 3 of the pattern. The warning signs appear. Smart money begins exiting quietly. Insiders liquidate. The professionals start hedging, but the crowd doesn't notice. They're too intoxicated by gains to see the exits being blocked. Now we come to September 3rd, 1929, the peak. The Dow Jones Industrial Average closes at 381.17. Its all-time high a level. It won't reach again until 1954, 25 years later. At this moment, the average stock is trading at a price-to-earnings ratio of about 32. Some are much higher. RCA, the darling technology stock of the age, trades at an infinite PE because it pays no dividend and plows all earnings back into expansion. People own it purely for price appreciation. General Electric trades at 35 times earnings. General Motors at 40 times. These are industrial companies with tangible products and real revenues, and they're priced like growth tech startups. But here's the critical detail that almost nobody sees. Corporate earnings have already peaked. In the second quarter of 1929, aggregate corporate profits reach their high point. By the third quarter, they're declining. Factory orders are falling. Industrial production is down. Commodity prices are weakening. The real economy is rolling over. But stock prices keep climbing for 3 more months, completely disconnected from the fundamentals they're supposedly based on. This divergence is the signature of stage 4, when prices detach from reality entirely. When they rise purely on belief, on momentum, on the assumption that what went up will keep going up. The justification for these valuations comes from something called New Era thinking. The phrase appears constantly in newspapers, investment letters, and academic journals. This is a new era. The old rules don't apply. Technology has changed everything. Scientific management means corporations can grow indefinitely. Radio and automobiles and electrification. These innovations have created a permanent upshift in productivity. Stock prices aren't overvalued. They're just pricing in this brilliant future. Irving Fisher, the most respected economist in America, a Yale professor and mathematical genius, one of the founders of modern economic theory, gives a speech in October 1929. His exact words are, "Stock prices have reached what looks like a permanently high plateau." He's not a fool. He's not a shill. He genuinely believes that fundamental changes in the economy justify the valuations. He's wrong, but he believes it. And if Irving Fisher believes it, why shouldn't everyone else? The newspapers are full of articles explaining why stocks can only go higher. The Saturday Evening Post publishes pieces with titles like, "Everybody Ought to Be Rich." Investment advisors tell clients that holding cash is foolish, that you're missing the greatest wealth creation opportunity in history. Even skeptics are mocked. Anyone who questions whether stock prices might be excessive is dismissed as old-fashioned, as someone who doesn't understand the modern economy. This psychological shift is crucial. It's not just that prices are high. It's that high prices become their own justification. The fact that stocks have risen 300% proves they're worth it. The market is efficient. People say if stocks were overvalued, they'd be falling. Since they're rising, they must be fairly valued. It's circular reasoning disguised as wisdom, and it's inescapable. You can't argue with it because any counter-argument is rejected as pessimism or ignorance. Real estate had shown the exact same pattern earlier in the decade. Florida experienced a catastrophic land boom in the mid-1920s. Swampland was being subdivided and sold to speculators who never saw it, who had no intention of building on it, who just wanted to flip it to the next buyer. Prices rose to absurd levels based purely on the belief that prices would keep rising. Then, in 1926, the bubble burst. Thousands lost everything. It should have been a warning for the stock market. Instead, the psychology just moved from land to stocks. The same magical thinking, the same belief that appreciation is automatic, the same dismissal of risk. By September 1929, stock ownership has become a marker of sophistication. To not own stocks is to be left out, to be missing the party that everyone else is enjoying. Dinner conversations revolve around which stocks are hot. Cocktail parties turn into impromptu investment clubs. People brag about their gains, exaggerate their success, hide their losses. It's social proof on a mass scale. Everyone's doing it. Therefore, it must be right. This is stage 4. Valuations reach levels that make no mathematical sense. Skepticism is treated as ignorance. And the words, "this time is different," become gospel. Now let me show you what happens next. Because October 1929 doesn't start with a crash. It starts with a crack. Thursday, October 24th. The market opens and immediately there's heavy selling pressure. The Dow falls 11% by early afternoon. It's not panic yet. It's just unusual. Brokers scramble. Margin calls go out by the thousands. Investors are told to deposit more money or their positions will be liquidated. And many can't. They don't have more money. They're already leveraged to the maximum. So the selling begins. Not panic selling, forced selling, mathematical selling. When you're margined at 10-1 and prices fall 10%, you have no choice. The broker sells your stocks, whether you want them to or not. By midday Thursday, the ticker tape is running 2.5 hours behind. Trades are happening on the floor of the exchange, but investors across the country won't know the prices for hours. This creates a fog of war. Nobody knows where anything stands. Are they ruined? Are they okay? The uncertainty breeds more fear. Then something happens that will be remembered as a crucial moment. Around 12:30 p.m., a group of powerful bankers meets at the offices of J.P. Morgan, Thomas Lamont of J.P. Morgan, Albert Wiggin of Chase National Bank, Charles Mitchell of National City Bank. These are the titans of American finance. They announce they're forming a consortium to stabilize the market. They're going to buy stocks to stem the panic, and it works for about 4 hours. The market rallies into the close, cutting its losses. Friday is calm. Saturday markets are closed, but newspapers trumpet the rescue. The bankers have saved the day. It was just a temporary disturbance. Everything's fine. But it's not fine because over the weekend, thousands of investors receive margin calls by mail. And Monday morning they have to meet them or face liquidation. Monday, October 28th, opens with massive selling. The Dow falls 13% in a single day. Nearly 9 million shares trade a record. But it's Tuesday, October 29th, that becomes Black Tuesday, the most infamous day in stock market history. The opening bell brings a deluge of sell orders. Everyone wants out. Nobody wants to buy. The ticker tape falls hours behind immediately. By the end of the day, 16 million shares have traded a record that will stand for decades. The Dow falls another 12%. In 2 days, the market has lost 25% of its value. But that's just the beginning. Over the next 3 years, the Dow will fall from 381 to 41, an 89% decline, the worst bear market in American history. And it's not just stocks. Investment trusts, those leveraged vehicles that multiplied gains on the way up, they multiply losses on the way down. Goldman Sachs Trading Corporation, which launched at $100 per share in December 1928 and traded as high as $326, falls to $1.75, not 1.75% down, but 1.75 per share, a 99% loss. Shenandoah and Blue Ridge, the nested trusts, they essentially go to zero. Billions in wealth just evaporate. And this is stage 5 of the pattern, the crack. The moment when forced selling overwhelms all buyers, when leverage unwinds violently, when the mathematics of margin calls and liquidation create a cascade that feeds on itself. Now here's what's important to understand. The crash itself doesn't cause the Great Depression. The crash is the trigger. But the depression, the decade of misery that follows, that comes from what happens next. Stage 6. Let me walk you through it. After the crash, everyone's balance sheet is destroyed. Investors who were millionaires in September are bankrupt by November. But it's not just their problem. Banks lent money for those stock purchases. When investors can't repay, banks take losses. When banks take losses, they have to reduce lending to preserve capital. When they reduce lending, businesses can't get credit. When businesses can't get credit, they can't make payroll, can't buy inventory, can't invest in equipment, so they lay off workers. When workers lose jobs, they can't pay their mortgages or car loans. More losses for banks. The cycle spirals. By 1930, banks are failing. Not a few. Hundreds. In 1930 alone, over 100 to 300 banks closed their doors. Depositors lose everything because there's no FDIC, no deposit insurance. Your money was in a bank that failed gone. And this creates a second wave of panic. People who still have money in banks want it out. They start bank runs lining up to withdraw their savings before the bank fails. But banks don't keep all deposits in cash. They lend most of it out. So when everyone wants their money at once, the bank can't pay. Even healthy banks fail when subjected to runs. By 1933, over 10,000 banks will have failed. Half the banking system eliminated. But it gets worse because of debt deflation. This is the mechanism that turns a bad recession into a depression. Here's how it works. When asset prices fall, when businesses fail, when banks collapse, the money supply contracts. There's less money in circulation. With less money chasing the same amount of goods, prices fall. Deflation. On the surface, this sounds good. Things get cheaper, right? But deflation is catastrophic for a debt-laden economy. Here's why. Imagine you borrowed $10,000 in 1929 when bread cost $0.10 a loaf. That's $100,000 loaves of bread worth of debt. By 1933, bread costs $0.005 a loaf. Your debt is now equivalent to 200,000 loaves of bread. The real burden of your debt has doubled, even though the nominal amount hasn't changed. Now multiply that across millions of borrowers, farmers who took mortgages, businesses that borrowed for expansion, homeowners with loans. They're all being crushed by debts that grow heavier with each price decline. And when they can't pay, they default. More bank losses, more failures, more deflation. It's a death spiral. By 1933, the economy has contracted by nearly 30%. 1 in 4 workers is unemployed. Industrial production has fallen by half. International trade has collapsed by 65%. It's not just an American crisis. It's global, because all the world's economies are linked through the gold standard, through trade, through debt. When America collapses, it drags everyone down. This is stage 6, the cascade, where the initial shock propagates through every part of the economy. Where leverage unwinds credit contracts and deflation traps everyone in debt they can't repay. Where forced selling in one market triggers failures in others. Where the system doesn't gradually adjust, it convulses. And finally, stage 7, the aftermath. The recognition that the damage is permanent, that the economy won't bounce back quickly, that an entire decade will be lost. By 1933, faith in the financial system is shattered. Faith in capitalism itself is wavering. People look at breadlines and Hoovervilles, and they wonder if the entire American experiment has failed. Desperate times breed desperate politics. In Germany, economic collapse helps bring Hitler to power. In America, FDR wins in a landslide and begins an unprecedented expansion of federal power. The New Deal creates programs that will reshape American society. Social Security unemployment insurance, federal deposit insurance, securities regulation. These aren't ideological choices. They're emergency measures to prevent complete social collapse, and monetary policy changes forever. In 1933, FDR takes America off the gold standard domestically. The dollar is devalued, gold is confiscated. The government essentially defaults on its promise to redeem currency for a fixed amount of gold. And slowly, painfully over the course of a decade, the economy stabilizes. But it never truly recovers until World War II forces massive government spending and industrial mobilization. That's what it takes. a global war. This is stage 7, the aftermath, where the economy reaches a new equilibrium, but one far below its previous peak, where an entire generation's wealth and trust are destroyed, where the political and social order is permanently altered. Now let me show you why this matters today. Because we're not studying 1929 as history. We're studying it as prologue. Every element of that 7-stage pattern is present in 2025. Let's go through them systematically. Stage 1, easy credit creates artificial prosperity. Check. From 2008 to 2022, the Federal Reserve held interest rates at or near zero for most of that period. They printed over $8 trillion through quantitative easing. The European Central Bank and Bank of Japan went even further, experimenting with negative interest rates. The entire global financial system ran on free money for over a decade. Corporate debt in America has exploded from $7 trillion in 2008 to over $12 trillion today. Much of it used not for productive investment, but for share buybacks and dividends. Money that could have built factories or developed products instead went to financial engineering. Household debt is back to pre-2008 levels. Credit card debt just hit $1 trillion. Student loans are nearly $2 trillion. Auto loans are $1.5 trillion. Mortgages are over $12 trillion. Total household debt exceeds $18 trillion. That's over $60,000 for every man, woman, and child in America. And globally, total debt exceeds $315 trillion, 3 times global GDP, the largest debt burden in human history. Stage 1 isn't just complete. We've gone far beyond what existed in 1929. Stage 2, speculation replaces investment. Check. Let me just list what we've seen in the last 5 years. Meme stocks GameStop and AMC, driven by Reddit forums to valuations that bear no relationship to their businesses. NFTs, digital images, selling for millions of dollars. SPACs, blank check companies that raise billions without even identifying what they're going to buy. Cryptocurrencies, trillions in market value for digital tokens that produce nothing and are backed by nothing. Robinhood traders buying options they don't understand. Retail investors piling into markets during COVID, lockdowns, day trading from their bedrooms. Companies with no profits trading at 100 times revenue. Tesla at one point had a market cap larger than all other automakers combined, despite selling a fraction of the cars. And then there's the everything bubble. Stocks, bonds, real estate, commodities, crypto, all rising simultaneously. That doesn't happen when money is allocated rationally. That happens when too much money is chasing too few productive opportunities. Speculation has become the dominant economic activity. More money is made by trading assets than by producing goods or services. High-frequency trading algorithms that hold positions for milliseconds. They're not investing. They're skimming pennies from volatility. Day traders who can't name the CEO of companies they own. Retail investors following Twitter influencers and TikTok tips. This is not capitalism. This is a casino where everyone thinks they're playing with house money. Stage 2, complete. Check. Stage 3, smart money begins to exit. Check. Warren Buffett is sitting on $125 billion in cash, more than Berkshire Hathaway has ever held. He's not deploying it. He's waiting. Corporate insiders have been selling at record levels. CEOs and board members unloading shares while publicly expressing confidence in their companies. The smart money sees what retail investors don't. Hedge funds have built the largest short positions in history. They're betting billions on declines not because they're pessimistic, but because they're reading the same mathematics that preceded every crash. Foreign investors are reducing holdings of U.S. stocks and bonds. Central banks outside the U.S. are buying gold instead of treasuries. That's a vote of no confidence in dollar-denominated assets. The signals are everywhere for those who know how to read them. And just like 1929, most people aren't paying attention. They see stocks at all-time highs and think that means they should buy. They don't understand that all-time highs in mature bull markets are often the most dangerous moment to enter. Stage 3, complete. Check. Stage 4, prices reach absurd valuations justified by new era thinking. Check. This time is different. Sound familiar? We heard it about dot-com stocks in 2000. We heard it about housing in 2006, and we're hearing it now. The justifications are always the same. Technology has changed everything. The old metrics don't apply. This time it's AI digital transformation, the fourth industrial revolution. These innovations justify any valuation. Just like radio and automobiles justified valuations in 1929, companies losing billions trade at market caps in the hundreds of billions. Why? Because they're disrupting, because they're innovative, because in the future they'll dominate. Maybe. But how do you value maybe Tesla trades at a higher multiple than Ferrari, even though Ferrari has higher margins and actually makes money? Why? Because Tesla isn't a car company. It's a technology company. It's an AI company. It's whatever narrative you need it to be to justify the price. And crypto. Let's talk about crypto. Trillions in market value for assets that produce nothing. No dividends, no cash flow, no earnings. Just the belief that someone will pay more in the future. That's not investment. That's speculation backed by nothing but collective delusion. And when someone points this out, they're dismissed. They don't understand blockchain. They don't understand decentralization. It's old-school thinking applied to a new paradigm. It's the exact same dismissal of skeptics that happened in 1929. Stage 4, complete. Stage 5. This is where we are right now. The crack. It hasn't happened yet, but we're in the moment before. The moment when leverage is at its peak, when confidence is total, when everyone believes nothing can go wrong because that's always when it goes wrong. The mathematics of leverage and forced liquidation that destroyed markets in 1929, they're still valid. They never stopped being valid. When everyone owns assets on borrowed money, when everyone's balance sheet is levered, when the entire system depends on prices continuing to rise, a small decline triggers a cascade. Margin calls forced selling falling prices more margin calls. It becomes unstoppable. And the difference today is scale and speed. In 1929, margin calls were sent by mail. Liquidations took days. Today, everything happens in seconds. Algorithmic trading, automated margin systems, high-frequency programs. When the selling starts, it will happen faster than human comprehension. Markets will gap down before anyone can react. Circuit breakers will trigger. Trading will halt. And when it reopens, the offers will be pennies on the dollar because nobody wants to catch a falling knife. We're in stage 5 waiting for the crack. And when it comes, stages 6 and 7 will follow with the same mechanical precision they followed every other time. The cascade, the aftermath, the decade of repair. Now I need to show you something most people miss about 1929. The crash wasn't random. It was inevitable. Not because of that one gunshot in Sarajevo, wrong war, but because the mathematics guaranteed it. When credit grows faster than income, when speculation replaces production, when everyone believes prices can only rise, the system becomes unstable. Not metaphorically unstable, mathematically unstable. And unstable systems don't gradually adjust. They collapse suddenly. The question was never if, only when. And the same is true today. The mathematics haven't changed. The psychology hasn't evolved. We've just convinced ourselves that we're smarter, that our technology and our policies make us immune to old patterns. We're not. The pattern is playing out right now. We're in stage 5 of 7. And history says what comes next. If this analysis changes how you see today's markets, I need you to understand something. The crash, when it comes, won't be your fault, but surviving it will be your responsibility. The pattern is clear. The stages are marked. We know what's coming because we've seen it before. 3 times, 1929, 1989, 2008. And each time those who prepared survived. Those who didn't lost everything. I'll see you on the other side.